The recession started 18 months ago. Not the one they'll announce on television, not the one where some economist points to 2 consecutive quarters of negative GDP and says, officially, we are now in a recession. I mean, the one already running underneath you right now, showing up in the fact that consumer credit card debt hit $1.2 trillion in 2025, that small business bankruptcies are up 31% year over year, and that the 10-year Treasury yield in early 2026 is sitting higher than it was at the peak of the worst inflation crisis America has seen in 4 decades. That's not a warning sign. That's the system already on fire, and somebody decided not to pull the alarm. And here's what makes this different from every other recession is coming video you've seen. We are not talking about a cyclical downturn. We are talking about the first measurable stages of a monetary system transition, a change in the rules of money itself. And your 401k was designed for the old rules that right now may be in the process of expiring permanently. So in the next 20 minutes, I'm going to walk you through the mechanics of how this actually works, the historical patterns, the 5 specific forces converging simultaneously that haven't all fired at once in 80 years, and the 3 things I'm actually doing with my own money, multiple hundreds of thousands of dollars spread across index funds, real estate, and yes, some gold, not because I want you to copy me, but because I want you to understand the reasoning clearly enough to apply it to your own situation. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Now, let me give you a metaphor. One we're going to keep returning to throughout this entire video because it does more explanatory work than any chart I could show you. Think of the global financial system as a massive commercial lease. After World War II, the world signed a lease with the United States. The terms were actually straightforward. The US dollar would serve as the global reserve currency, meaning every country would hold dollars in reserve and settle international trade, especially oil, in dollars. In exchange, the United States promised a stable currency, manageable inflation, and the military power to keep global trade routes open and safe. That lease has been running for 80 years, and for most of that time, it genuinely worked. Countries got access to a stable, universally accepted medium of exchange. America got an extraordinary privilege, the ability to print the world's reserve currency, which meant it could run deficits that would destroy any other nation on earth and still find buyers for its debt. Both sides of the lease benefited. But here's the problem with long leases. The landlord starts taking liberties, and the tenants start looking at what else is out there. The first liberty the US took was in 1971. Nixon closed the gold window. Before that, if you held dollars and you were a foreign government, you could theoretically exchange those dollars for gold at a fixed rate. After 1971, you couldn't. The dollar became backed by nothing except trust, and the full faith and credit of the US government. Trust is a psychological asset, and psychological assets don't decay linearly. They hold, they hold, they hold, and then they don't. We are in the and then they don't phase. And I'll show you exactly what that looks like in numbers in a few minutes. But first, I need to show you something about the structure of US debt that makes everything else in this video click into place. The US national debt is now $36 trillion. That is 120% of GDP. If you made $60,000 a year, but owed $72,000 on credit cards, your debt to income ratio would be identical to the United States government right now. Now, you might be thinking, okay, but we've had high debt before. After World War II, debt to GDP hit 106%, and we recovered. True. But here is the reversal I need you to understand. You think the debt level is the problem. The debt level is not the problem. The structure of the debt is the problem. After World War II, the US was demographically young. It had a massive domestic manufacturing base. It was a net creditor, meaning other countries owed us money, not the other way around. It had decades of productivity growth ahead of it to grow out of the debt. Now, aging population, offshore manufacturing, net debtor, and here's the number nobody wants to say out loud. In 2025, interest payments on the national debt exceeded $1 trillion for the first time in American history. More than the entire US defense budget. The United States is now spending more servicing its debt than protecting its borders. That is not a debt problem. That is a Ponzi structure. And Ponzi structures have exactly two endings. You either find enough new buyers to keep it going, or the whole thing collapses when the buyers disappear. For 15 years, the Federal Reserve played buyer of last resort. Every time Treasury yields spiked, every time the market said, we don't want to lend you money at these rates, the Fed stepped in, printed money, and bought bonds. It's called quantitative easing in polite company. In honest company, it's called monetizing the debt. And it works right up until it doesn't, because it is also called inflation. And here's the thing. Even after 2 full years of aggressive rate hikes, inflation is still running above the Fed's 2% target. The 10-year Treasury is yielding above 4.5%. That means the market is demanding more compensation to hold US government debt because the market is nervous. That nervousness is the lease getting wobbly. Now, in a few minutes, I'm going to show you what the actual endgame scenarios look like, including one involving Bitcoin and geopolitics. That sounds insane until you trace the incentives. But first, I want to walk you through why every major signal Ray Dalio has been warning about for 5 years is now measurably flashing red. Because this is where it gets really interesting. Dalio runs Bridgewater Associates, the largest hedge fund in the world with over $150 billion under management. He spent years studying what he calls the big debt cycle, looking at every major reserve currency in history. The Dutch guilder, the British pound, the Spanish real. He found a pattern so consistent, it's almost embarrassing. Every reserve currency goes through the same arc: rise, dominance, overextension, decline. And at each stage, there are specific, measurable signals. He published a book called The Changing World Order in 2022, and I read it twice and then read it a third time with a highlighter. His framework identifies 5 forces that interact in these transitions. Internal order and disorder, meaning wealth inequality and political stability inside the dominant country. External order and disorder, meaning geopolitical alignment and conflict. The debt cycle, acts of nature, and technology. Normally, these forces operate at different rhythms. One is heating up, while another is cooling down. They partially offset each other. Right now, all 5 are flashing simultaneously. That hasn't happened in 80 years. Let me take internal disorder first. In 2024, the top 1% of Americans held 32% of all national wealth. The bottom 50% held 2%. That wealth gap is wider than it was in 1929, the year before the Great Depression. And here's what that actually means for your money, not in an abstract political sense, in a direct financial mechanics sense. When wealth inequality becomes extreme, it creates political instability. And political instability makes institutional investors nervous about holding long-term US government debt. If you're not sure a government will honor its obligations 20 years from now, you don't buy a 20-year bond at 4%. You buy gold. You buy hard assets. You move money into things that can't be inflated away or defaulted on. And that's exactly what we're seeing. Central banks around the world purchased 1,037 tons of gold in 2024, the second highest year on record since data collection began. China, Russia, India, Turkey, they are not buying gold because they think it's pretty. They are quietly, systematically reducing their exposure to dollar-denominated assets. This is the institutional equivalent of the smart tenant quietly touring apartments while still paying rent so as not to spook the landlord. The tenants are moving out, slowly, quietly, until they're not. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, let me bring in external disorder. This is the force that accelerated everything else. In 2022, the US locked Russia out of the SWIFT system, the global network that processes international bank transfers as financial punishment for the Ukraine invasion. It was called a financial nuclear option. It froze hundreds of billions of Russian foreign reserves denominated in dollars. And it worked in the short term. But here's the thing about nuclear options. You only get to use them once. After that, every country in the world that has ever been in a geopolitical dispute with the United States starts building a bunker. Here's a story that captures the dynamic A small island nation once conducted all of its trade through a single shipping company. The company had the only dock on the island. So the island paid whatever rates the company charged, followed whatever rules the company set, and didn't complain because what choice did they have? Then one year, the company seized a shipment over a political disagreement. The following year, a competing company built a second dock on the other side of the island. Suddenly, the island had a choice. And the moment it had a choice, the original company's pricing power vanished overnight. The SWIFT sanctions were the seized shipment. And right now, the second dock is being built in real time. Russia and China began settling energy trades in yuan and rubles. China and Brazil signed a deal to trade in their own currencies without dollar conversion. India started buying Russian oil with rupees. The Gulf states, the same countries that created the petrodollar arrangement back in the 1970s, are now openly discussing pricing oil in a basket of currencies. This isn't a fringe development being reported on financial conspiracy blogs. This is happening in diplomatic cables and finance ministry meetings. When you weaponize the dollar, you teach the world to build a financial system that doesn't need the dollar. That's not a conspiracy. That's incentives. If I can lock you out of the global payment system because I disagree with your foreign policy, you are going to build an alternative payment system. And once that alternative exists, every country that's ever worried about being next starts using it. Not because they hate America, because they have options. It's the psychology of a bank run. The bank doesn't fail because it's insolvent. It fails because people think it might become insolvent. So they pull their money out, which makes it insolvent. Self-fulfilling prophecy. Now, I want to introduce you to Marcus. He's not a specific person, but I've seen his pattern in enough conversations with real people that he might as well be. Marcus is 44 years old. He has been maxing out his 401k since his late 20s. He has a diversified portfolio, roughly 60% equities, 40% bonds, a standard target date fund. He checks his balance every quarter, and the number goes up, and he feels good. Marcus is the tenant who just renewed his lease for another 5 years without reading the new clauses. I'm going to come back to Marcus, because what happens to Marcus over the next decade is the entire point of this video. Now let me give you a specific case study with real numbers, because this is where theory meets your actual financial situation. Meet David. He's 42. He has $350,000 in his 401k, almost entirely in a target date fund. Set for 2047, he earns $110,000 per year. He contributes 6% of his salary with a 3% employer match. He's run the numbers on every major retirement calculator he could find. They all tell him roughly the same thing. He'll retire at 65 with approximately $1.8 million. On paper, David is doing great. Here's what those calculators assume. 7% average annual real returns, 2.5% average annual inflation. And this is the assumption nobody ever states explicitly, that the dollar in David's account in 2026 buys roughly the same basket of goods as the dollar he retires with in 2047. Blow up any one of those three assumptions, and David's entire retirement math falls apart. Take inflation. If the US government, facing a debt crisis and unable to attract sufficient foreign buyers for its treasury bonds, decides to let inflation run hot, deliberately eroding the real value of its debt over time, which is exactly what every over-indebted government in history has eventually done, from post-war Britain to 21st century Argentina, and inflation averages 5% annually instead of 2.5% over the next 23 years. David's $1.8 million at retirement only purchases what, $800,000 purchases today? He just lost $1 million of purchasing power. And his brokerage statement will still read $1.8 million. The number looks the same, the purchasing power is gone. Now hit the second assumption. If dollar reserve status erodes meaningfully, even partially, not catastrophically, the US has to raise interest rates to attract buyers for its government debt. Higher rates mean lower bond prices. They also mean lower stock valuations, because every stock price is ultimately a discounted cash flow calculation using an interest rate as the denominator. Raise the rate, reduce the present value of future earnings. The S&P 500 is priced for a world where the US can borrow cheaply, essentially forever. If that assumption cracks, we are not talking about a 10 or 15% correction. We are talking about a fundamental repricing of every financial asset denominated in dollars. David's target date fund, which automatically shifts toward bonds as he approaches retirement, because that's the design, that's what the brochure says, gets destroyed in a rising rate environment. Long duration bonds lose value when rates rise. That is not a forecast, that is arithmetic. And here's the asymmetry I want you to feel. David has spent 16 years doing everything the system told him to do, contributing consistently, not panic selling, staying diversified. And the scenario where he loses $1 million of purchasing power is not a black swan event. It is a reasonably likely consequence of a monetary transition that is visibly underway right now. The people who get hurt worse in monetary transitions are not the reckless gamblers. They're the disciplined savers who trusted the system completely and never questioned which game they were playing. That's not a design flaw. That's a feature. The system depends on people like David staying calm and staying put. Let me take a quick detour here, because this is a lot of structural doom, and I think we both need a breath. Imagine you're the Federal Reserve Chair in 2028. You're sitting in a mahogany paneled room with 3 advisors. First advisor says, if we raise rates, we crash the stock market and Congress summons you to testify for 6 hours. Second advisor says, if we cut rates, inflation goes back to 8% and the same Congress summons you to testify for 8 hours. Third advisor says, if we do nothing, the bond market stages a revolt, and wait for it. Everyone in that same Congress blames you personally, and you're just sitting there in a $6,000 suit thinking about the McKinsey partnership offer you turned down back in 2009, wondering if it's too late to call them. That's not satire. That is genuinely the position the Fed is in. Every tool they have carries a downside approximately as bad as the problem it's meant to solve. That's what it looks like when a Ponzi structure starts running out of new buyers. Now, stay with me, because this next part is what most financial commentators miss entirely, and it changes how you think about solutions. There's a fourth force in Dalio's framework that we haven't discussed yet: technology, specifically artificial intelligence. And this is where things get complicated in an interesting way, because AI might be the only deflationary force powerful enough to partially counterbalance everything else I've described. The IMF published a working paper in 2024 projecting that AI could affect 40% of jobs globally. If AI drives the cost of goods and services down meaningfully, maybe that counteracts inflation. Maybe it buys the US time to stabilize its fiscal situation. Maybe. But here's the other side. If AI displaces 40% of jobs and those workers stop earning income, they stop paying taxes, they stop consuming, and the government has to step in with more spending to stabilize the economy, which means more deficit, which means more treasury issuance, which means more downward pressure on dollar credibility. You see how these forces stack, compound, cancel, and interact with each other simultaneously. This is not a linear problem you can solve with a single policy lever. It's a system. Now here's where the scenario gets genuinely weird. And I want to be careful here because I'm not a geopolitical analyst. I'm someone who reads the documents and traces the incentives. There is a real possibility, not a certainty, not even a probability, but a real and non-trivial possibility that the US response to all of this is to back the dollar with something tangible again. 2 versions of this exist. On the gold side, the US reportedly holds 8,000 tons of gold, ostensibly in Fort Knox, though it hasn't been subject to a meaningful independent audit since the 1950s. At current prices near $3,000 per ounce, that gold is worth approximately $760 billion, which sounds substantial until you remember the national debt is $36 trillion. To collateralize even 10% of outstanding treasury debt with gold, you need to revalue gold above $43,000 per ounce. That math does not work unless you simultaneously revalue gold at multiples of its current price, which would itself be a massive monetary disruption. On the Bitcoin side, this is the scenario that would have sounded unhinged 2 years ago and sounds merely improbable today. The US government currently holds over 200,000 Bitcoin, accumulated primarily through criminal seizures. Several sitting senators have introduced legislation around a strategic Bitcoin reserve. And if the US were to formally announce treasury instruments backed by Bitcoin, not just holding it, but pledging it, it would legitimize crypto as a reserve asset overnight in a way that no amount of private adoption ever could. Now, here's a pattern interrupt I want you to sit with for a moment. Venezuela reportedly holds somewhere around 600,000 Bitcoin, accumulated through years of government mining operations and seizure from domestic crypto operations. The United States has recently been increasingly attentive to Venezuela, diplomatically and otherwise. That's probably a coincidence. But when you understand that reserve currency competition is fundamentally a war fought with monetary instruments rather than conventional weapons, you start seeing the connections between events that look completely unrelated in daily news coverage. Incentives explain behavior better than almost any other analytical framework. Always follow the incentives. Picture this. You're Xi Jinping. You've spent 15 years and an estimated $1 trillion building the Belt and Road Initiative, lending money to developing countries in exchange for long-term influence and a global market for the yuan. You're building the second dock on the island. You're making real progress. And then the United States announces in a single Treasury Department press release that the dollar is now backed by a Bitcoin reserve. Do you call their bluff? Do you dump your $2 trillion in US Treasury holdings, crash the American bond market, and ignite a full financial war? Or do you cooperate, knowing cooperation means accepting a monetary system where the US still writes the rules, your gold reserves have lost their strategic advantage, and the decade of infrastructure lending you used to build alternatives now looks far less valuable? It's like sitting down to a poker game, building a significant chip stack over 3 hours, and then having the dealer announce mid-hand that the game is now chess. You can walk away and forfeit everything you've accumulated. Or you can stay and play a game where the rules just change without your consent. That's the actual calculation being made in Beijing right now. That's not hyperbole. That's the geopolitical reality. And here is where I come back to Marcus. Remember, Marcus, 44, diligently maxing his 401k, checking his balance quarterly, feeling good because the number on the screen keeps going up. Here's what Marcus almost certainly doesn't know. If he actually opened the prospectus of his target date fund, and I know this because essentially nobody reads the prospectus of a target date fund, he would find that his fund holds approximately 67% US equities and 23% US bonds, with the bond allocation set to automatically increase as he approaches his target retirement date. His entire financial future is essentially a concentrated bet that US dollar stability persists and US borrowing costs remain manageable for the next 20 plus years. That is not a diversified portfolio. That is a single macro bet on American monetary policy, dressed in a diversified portfolio costume. And here's what makes that uncomfortable. Maybe that bet pays off. I genuinely don't know. Nobody does. But understanding the bet you're making is the minimum requirement for making it consciously. Marcus is making a large, concentrated macro bet without knowing he's making any bet at all. That is the problem. Not the portfolio construction itself, the unconscious nature of it. Also, and this is worth noting, the financial industry has a structural incentive to keep Marcus from examining this too closely. The entire business model of target date funds depends on consistent contributions and low engagement. The fund company earns fees on every dollar in that fund, regardless of how the monetary environment performs. They are not incentivized to explain the macro risks embedded in their product. That is not malice. That is incentives. Again, always incentives. Here is the most underappreciated scenario in all of this, one that almost nobody discusses because it's neither catastrophic enough for doom media nor optimistic enough for standard financial advice. The most likely outcome of this monetary transition is not the collapse of the dollar. It is a multipolar monetary system. In the same way the world shifted from being organized around the British pound in the 1890s to being organized around the dollar after World War II, not in a single crisis, not in a day, but across decades of gradual structural shift, we are probably moving toward a world where the dollar is one of several reserve currencies. Maybe the dollar the euro, the yuan, the IMF's special drawing rights instrument, and some form of commodity-backed digital currency, all operating simultaneously at different weights in different regions. In that world, the dollar doesn't collapse. It weakens gradually. 5% one year, 3% the next. Over a decade, you don't feel it until you try to price your retirement in terms of what it actually buys. And by then, you've lost a decade of compounding adjustments you can never recover. Here's a number that captures the scale of that problem. If you measure the S&P 500, not in nominal dollars, but in ounces of gold from 2001 to 2025, the market is roughly flat over that entire period. Not up 500% like the dollar-denominated chart shows, essentially flat. Because gold has appreciated at approximately the same rate as the broad stock market over that time frame, which means what the market returned in nominal terms, monetary expansion mostly eroded in real terms. Marcus isn't winning, he's treading water, but his statement says he's winning. And that gap between perception and reality is the most dangerous psychological position to be in when the rules of the game actually change. I've spent over 10 years running my own business, working directly alongside accountants and fiscal lawyers who showed me how money actually moves behind the formal numbers. And the consistent lesson across all of that is this: the game is not about being the smartest person in the room. It's about understanding which game you're playing, and specifically about being one of the first people to notice when the rules change. Most people are still playing the 1985 version of this game. Low inflation, stable dollar, bonds as the safe anchor, equities up over any 20-year period. That game produced a lot of wealth for a lot of people. But the conditions that made it work are under genuine structural pressure for the first time in a generation. Now, to be absolutely clear, none of this means you should panic and liquidate everything. Panic is the worst possible response to a slow-moving structural shift. When you panic, you sell at the bottom, buy gold at the top, and make a dozen emotional decisions that individually feel like prudent risk management and collectively destroy your portfolio. The right response is calibrated adjustment over time, informed by an understanding of the actual forces at work. So let me give you three things. Three specific, non-generic responses calibrated to this exact moment. Not general financial advice, not diversify as a vague concept. The actual framework. First, stress test your retirement projections against 5% average annual inflation instead of 2.5%. Every retirement calculator defaults to 2.5. Change that number to 5 and see what it does to your projected purchasing power at retirement. If the result is catastrophic, you need to know that now, not at 63. If the result is manageable, excellent, your plan is more resilient than you thought, and you can carry on with higher confidence. Second, look at the duration of your bond holdings. If you have a target date fund, look up its average bond maturity. The fund should list this in its prospectus or its fact sheet. If your average bond maturity is above 10 years, you have significant duration risk in a potentially rising rate environment. A 30-year treasury bond loses roughly 20% of its market value for every 2 percentage point rise in interest rates. Moving towards shorter duration bonds or treasury bills, which are currently yielding between 4 and 5% with almost no duration risk, is not a bearish bet. It's removing an unnecessary and uncompensated risk from your portfolio. Third, introduce some exposure to assets that are not positively correlated with the dollar. This does not mean abandoning your index funds. It means acknowledging that having 100% of your net worth in dollar-denominated assets is itself a concentrated position, and that deconcentrating that position is not paranoia, it's standard portfolio construction. That could mean international equities in developed markets, a modest allocation to gold, which was up 29% in 2024 alone. A small Bitcoin position, not because it's the future of money, but because if there's even a 10% probability, it becomes part of the global reserve architecture. The asymmetry of the upside is genuinely hard to ignore. And income-producing real assets, rental property, a business, skills that generate value regardless of what currency they're denominated in. The people who survived every monetary transition in recorded history were not the ones who held the most gold or the most cash. They were the ones who owned things that generated genuine value, independent of any particular monetary system. That principle is older than the Federal Reserve. It's older than the dollar. It will outlast whatever comes next. And let me come back to Marcus one final time, because this is where the subplot resolves. Marcus might be fine. He might retire in 2047 and discover that the dollar remained dominant, inflation stayed moderate, and his target date fund delivered exactly what the brochure promised. That outcome is genuinely possible. But Marcus is not making a conscious choice. He's making an unconscious bet with his entire retirement on a very specific macro scenario. And there is a meaningful, data-supported, historically grounded probability that the macro scenario he's betting on is not the scenario that actually plays out. Understanding the bet you're making is not pessimism. It's basic financial literacy. And right now, most people don't have it because the financial industry profits from them not having it, and nobody reads the 800-page Bank for International Settlements reports that explain in careful academic language that yes, the system is under structural stress. I read those reports. That's what this channel is. I read the boring documents so you don't have to, and then I tell you what actually matters. The lease is up for renegotiation. Not necessarily for termination, for renegotiation. The terms that the world accepted for 80 years because no viable alternative existed are now being questioned by players with enough economic mass to credibly threaten to walk away. Whether the world signs a new lease on dollar terms, builds an alternative system, or muddles through some messy multipolar arrangement, being aware that the negotiation is actively happening right now is the foundational requirement for making intelligent financial decisions over the next 20 years. Because here's the thing about slow-moving disasters, and I know this sounds cynical, but I think it's just true. The people who get hurt worst are not the uninformed optimists who never looked at the data. They're the people who were informed, saw the signals, made a mental note to deal with it later, and then didn't. That's not optimism. That's expensive denial. And at compounding rates, expensive denial is the most reliable way to destroy wealth that I have ever observed. Lazy investing built more fortune than crypto memes. But lazy investing in 2026 means understanding the macro environment your portfolio is operating inside of, not ignoring it in the name of passive strategy. The strategy is still the same. Invest consistently, minimize fees, let compounding work. What's changed is the backdrop. And understanding the backdrop is not optional anymore. The tenants are moving out, the landlord is changing the lease terms mid-contract, and the apartment building next door is starting to look real.